Microsoft just spent the last decade convincing every business on Earth they need Office 365. Salesforce built a $250 billion empire selling customer management software. Now, both companies are facing an existential crisis, and if you've got money in Australian tech stocks or global funds, you need to understand what's happening here. Because artificial intelligence isn't just changing how these software giants operate, it's threatening to make them irrelevant. And the way they're fighting back tells us everything about where the next decade of investing returns will come from. Here's what's actually happening. For 20 years, big software companies like Microsoft and Salesforce have made money the same way. They build complex platforms, train your staff to use them, lock you into multi-year contracts, then charge you more every year for features you didn't know you needed. It's been brilliant business. Salesforce trades on the NYSE at around 50 times earnings. Microsoft's market cap hit $3 trillion. These aren't just software companies, they're cash printing machines. But AI is changing the fundamental equation. Instead of learning Salesforce's complicated interface to manage your customers, you might just tell an AI assistant what you want. Instead of wrestling with Excel formulas, you could describe your analysis in plain English and get instant results. Suddenly, all that complexity these companies charged premium prices for, it might just become unnecessary. This isn't theoretical anymore. We're seeing AI tools that can analyze spreadsheets, write reports, manage databases, even code websites. The barrier between what a human wants to do and actually doing it is disappearing fast. So Microsoft and Salesforce are scrambling. Their new pitch? Sure, AI will change everything, but you'll still need our platforms. You'll just use them differently. Think of us as the foundation that makes all this AI magic possible. Microsoft's betting big on this with Copilot, their AI assistant built into every Office product. Salesforce is pushing Einstein AI across their customer management tools. They're essentially saying, don't replace us, let us be your AI gateway. But here's the billion-dollar question. Will it work? Let's think about this from an Australian business perspective. Right now, a typical Melbourne marketing agency might pay $150 per employee per month for Microsoft 365, plus another $200 per user for Salesforce. For a team of 20, that's $84,000 a year just for software. If AI can deliver 80% of that functionality for $20 per employee per month, the math gets very uncomfortable very quickly for Microsoft and Salesforce. And this isn't just happening in Silicon Valley. Australian companies are already experimenting with AI alternatives. The ASX-listed tech companies we invest in through our super funds are watching this transformation closely because it affects everyone. Here's where it gets interesting for your money. The software sector has been one of the best performing parts of global share markets for the last decade. If you've got international shares in your super, and most of us do through index funds, you own pieces of Microsoft, Google, Apple, and hundreds of other tech companies. The question is whether these giants can successfully pivot to an AI-first world, or whether they'll go the way of Nokia and BlackBerry, household names that missed the next big shift. Early signs are mixed. Microsoft's done this before. They nearly got killed by Google and mobile phones 15 years ago, then reinvented themselves as a cloud computing powerhouse. Their Azure platform now generates $25 billion in annual revenue. Salesforce is trickier. They've built their entire business on being the go-to platform for customer management. But what happens when any business can just describe what they want? Show me all customers in Sydney who haven't bought anything in 6 months and send them a personalized offer. And AI handles everything without needing Salesforce at all? The companies are making the same argument we heard from taxi companies when Uber arrived. You still need transportation. You just use it differently. We'll adapt. We know how that story ended, but software might be different. These platforms have something taxis didn't: massive amounts of data and existing relationships. When Microsoft adds AI to Excel, they're not starting from scratch. They've got decades of user behavior, billions of spreadsheets, and integration with every other business tool you use. That creates what investors call a moat, competitive advantages that are hard for new players to replicate. The question is whether AI makes those moats deeper or just washes them away entirely. For Australian investors, this plays out in several ways. First, if you own global share index funds through your super, you're exposed to this transition whether you realize it or not. The top 10 holdings in most international funds include Microsoft, Apple, Google, and other tech giants navigating this shift. Second, Australian tech companies on the ASX are dealing with the same pressures. Companies like Atlassian, which makes project management software, or Seek, which runs job boards, they're all asking the same question. How do we stay relevant when AI can potentially do what we do, faster and cheaper? The smart money seems to be betting on the incumbents, at least for now. Fund managers are backing large-cap tech stocks over smaller competitors. The theory? Big companies have the resources to acquire AI startups, hire the best talent, and integrate new technology into existing platforms. It's the classic, if you can't beat them, buy them strategy. Microsoft didn't build their AI capabilities from scratch. They partnered with OpenAI. Google's racing to integrate AI across every product. Amazon's building AI into their web services. But here's what's really interesting. This transition is happening faster than anyone expected. 2 years ago, most people had never heard of ChatGPT. Now businesses are restructuring entire departments around AI tools. That speed of change creates opportunity and risk in equal measure. Companies that get this right could see their profits multiply. Those that get it wrong might not survive the decade. So what does this mean for your money? 3 things. First, diversification matters more than ever. Don't bet everything on tech giants figuring this out. Spread your investments across sectors, geographies, and company sizes. The Australian share market, property, bonds, international shares. Balance is your friend during periods of massive technological change. Second, pay attention to how companies in your portfolio are adapting. This isn't just about Microsoft and Salesforce. Every business that relies on software, data, or customer relationships is being affected. When you see companies in your super funds or direct share investments talking about AI strategies, that's not marketing fluff. It's survival planning. Third, remember that disruption creates winners and losers. The internet killed bookshops, but created Amazon. Streaming destroyed video rental, but built Netflix. AI will eliminate some business models and create others we haven't imagined yet. The companies fighting for their lives today, Microsoft, Salesforce, Google, Apple, they're not going away quietly. They've got trillion-dollar war chests, the best talent money can buy, and every incentive to figure this out. But history suggests that when technology shifts this dramatically, some giants fall and new ones rise. The question isn't whether change is coming. It's already here. The question is which companies will successfully ride the wave and which will get crushed by it. Your job as an investor isn't to predict exactly how this plays out. It's to position your money so you benefit regardless of who wins. That means owning a mix of established companies adapting to AI, newer companies built around AI, and plenty of investments that have nothing to do with technology at all. Because while Microsoft and Salesforce fight for their lives in Silicon Valley, Australians still need houses, food, energy, healthcare, and infrastructure. Some of the best investment returns over the next decade might come from the most boring, untechnological companies you can imagine. The software wars are just beginning. Make sure your portfolio is ready for whatever comes next. This is general information only and not financial advice. Please speak to a licensed financial advisor before making any investment decisions.